After 1971, when this was put into the hands of the central bankers, which is a private corporation, that's when the real shift away from the public began. It actually started back in 1930 when they installed them. But now the U.S. money supply is falling at the fastest rate since the 30s, and I did go back to the 30s. Well, you're going to see everything here, but you can see where this shift occurred, and I'm going back one more time. You don't see anything that major throughout this, even after liftoff. A teeny bit over here, which would have been about 2008, but huge right here. Make no mistake about it. Make no mistake about it. This cannot last much longer. Because if inflation and GDP is supposed to follow the money supply, what does this sudden decline mean for our future? And boy, all of that money printing barely had any impact on GDP. Because this is the spot price of gold, which some of you watching may have noticed that it went above $2,000. And you might even say, whoop-de-doo, isn't that fabulous? But remember, they can create as much digital gold that does not nor ever will exist. They could do it with silver too, through the derivatives market. So let's just look at this long-term chart. Now this graph is adjusted for inflation. So even though the official price of gold was $20.64 an ounce back in 1915, and today the official price of gold is $42.22. Well, that's not really reality. Back in 2015, from how much new money they printed, so inflation adjusted, it would have been $600 an ounce, even though the face value was $20 an ounce. 1934, okay, they did that revaluation where they revalued this against that. That's always the way they do the those overnight revaluations. And you can see how rapidly spot gold went up. Here, that was the first revaluation. Then here, then there, okay? 1970, all right, pushed it all the way down because after all, they don't want you to know a rising gold price is an indication of a failing currency. And the US dollar as the world reserve currency was certainly failing on a global basis in 1970. And as I told you before, there was a run on the dollar. So once they released gold from its tethers after 1971, you can see that in inflation adjusted terms, it went up to $2,600. Okay, have we hit that yet? No. Will we do it this year, next year? Maybe. But is that still the value of it? No, not really. But what we do have here forming is a wedge. And I've talked to you about wedge formations. Now, this was on the 17th. Today, like I said, it broke above. But what you're likely to see is spot gold going into a range until it breaks above here, okay? Once it breaks above here, then the next most likely outcome is it for it to go even higher. And we do have that wedge formation. How do you get it? Higher and higher lows, lower and lower highs. Looks like a wedge of cheese. If it breaks down below, the most likely outcome is for it to continue to drop. If it breaks out above, the next most likely outcome is for it to go much higher.
Lynette Zang's analysis provides a deep dive into the shift in economic control from the public to private central banks, particularly following the pivotal moment in 1971 when the U.S. abandoned the gold standard. This transition marked a significant change in the financial landscape, one that continues to impact the global economy today. Zang's focus on the role of gold in providing economic stability during these turbulent times underscores its importance as a hedge against the uncertainties of fiat currencies. The decision to sever the dollar's link to gold in 1971 is often cited as one of the most significant moments in modern economic history. Before this, the US dollar was directly tied to gold, which acted as a check on how much money could be printed. By removing this tether, the US government and the Federal Reserve gained the ability to print money without any physical backing. leading to an era of fiat currency that is controlled solely by central bankers. This shift had profound implications. Without the discipline imposed by the gold standard, the money supply could be expanded at will, leading to periods of significant inflation. Zang points out that this change marked the real beginning of the public's disempowerment in economic matters. The public no longer had a direct connection to the value of their money through gold. Instead, they became subject to the decisions of central bankers, a private corporation whose interests are not always aligned with those of the general population. Zang draws a parallel between the current decline in the U.S. money supply and the dramatic contraction that occurred during the 1930s, leading up to the Great Depression. Today, the U.S. money supply is falling at a rate not seen since that era, raising alarm bells about what this could mean for the future. Historically, a shrinking money supply has been associated with deflationary pressures, which can lead to economic stagnation or depression. What makes the current situation even more concerning is that despite massive amounts of money printing in recent years, particularly following the 2008 financial crisis, the impact on GDP has been minimal. This suggests that the traditional relationship between money supply growth and economic growth may be breaking down. The vast amounts of new money entering the system have not translated into the kind of robust economic growth one might expect. Instead, much of this money has found its way into asset bubbles in the stock market and real estate, rather than into productive investments that drive GDP growth. In this context, gold emerges as a critical asset. Zang highlights how gold has historically been revalued against fiat currencies during times of economic instability. For instance, in 1934, the U.S. government revalued gold from $20.67 per ounce to $35 per ounce, effectively devaluing the dollar. This move was intended to stimulate the economy by increasing the money supply while maintaining the value of gold. Today, as the official U.S. price of gold remains artificially low at $42.22 per ounce, the actual market value of gold is significantly higher, hovering around $2,000 per ounce. This discrepancy underscores the disconnect between the official valuation of gold and its real-world value as perceived by the market. Zang argues that the market is beginning to overwhelm the ability of central banks to suppress gold prices, signaling a potential pattern shift that could lead to a significant revaluation of gold in the near future. Zang stresses the importance of recognizing these pattern shifts in the economy. The formation of a wedge pattern in the gold market, as she describes, indicates that gold is poised for a breakout. If gold breaks above the upper limit of this wedge, it could signal the beginning of a major upward trend, driven by increasing demand for gold as a safe haven asset in times of economic uncertainty. This potential breakout in gold prices is not just a technical analysis point. It reflects the broader economic reality that fiat currencies are losing their purchasing power. As inflation erodes the value of paper money, investors and central banks alike are turning to gold as a store of value. This shift is a clear indication that the current fiat currency system is under strain and that a revaluation of gold is likely on the horizon.
So we're going to see where all of this takes us, but you can see that there is likely to be a pattern shift. And even though the official U.S. price of gold is $42.22, which is where it's been since 1970, if you're buying, and I don't even have any, so I can't even show you, but if you're buying bullion like an American Eagle, it's got a face value of $50. You're going to sell it for $50? Did it cost you $50 to buy it? It's part of the psychology, though. Definitely. So what I really want you to notice here, though, is that we have seen some key major pattern shifts that have occurred in the money supply and the money velocity. I take this so seriously. I cannot tell you how seriously I take it. But there is also a pattern shift that is developing in spot gold, too. And I take that just as seriously. We're going to watch it. They're going to have to suppress it. But what this really shows me is that the markets are overwhelming the ability of suppression. So we're coming to it. We'll see what happens. But I did want to go over that more thoroughly because of how critically important I view this pattern shift to be. And I told you when I saw that the inflation was kicking in, that I felt that that was the beginning of the hyperinflationary event. event. And I got to tell you, all of the signals I'm getting from this are confirming that. Maybe I'm wrong. Maybe they can, I don't know how. I mean, they've eroded your purchasing power since the moment you were born. You have lost purchasing power in the currency. How do you go below zero? How do you do it? They tested negative rates. That didn't work either. How do you go below zero? Breakdown of the consumer crisis that's looming, because the breakdown of the consumer, this is what's supporting this economy, right? When all else fails, then it's the little guys. And we talk about the wealth and income inequality. This is really why we have that disparity. Let's go back to that graph, okay? So this takes us through October 1st of 2023. And I mean, you may not realize why it's so sad, but it is really because things are changing and they are going to get real ugly. How much more money printing needs to be done? How much more inflation needs to happen before we shift into this new system? And will it work? No, it doesn't work. Frankly, insanity is doing the same thing over and over again and expecting different results. But after 1971, when this was put into the hands of the central bankers, which is a private corporation, that's when the real shift away from the public began. It actually started back in 1913 when they installed them. But now the U.S. money supply is falling at the fastest rate since the 30s. And I did go back to the 30s. Well, you're going to see everything here. But you can see where this shift occurred. And I'm going back one more time. You don't see anything that major throughout this, even after liftoff. A teeny bit over here, which would have been about 2008, but huge right here. Make no mistake about it. Make no mistake about it. This cannot last much longer. Because if inflation and GDP is supposed to follow the money supply, what does this sudden decline mean for our future? And boy, all of that money printing barely had any impact on GDP.
As Zang points out, the current decline in the U.S. money supply is unprecedented in modern times, echoing the patterns last seen in the 1930s. This sudden contraction raises significant concerns about the future of the U.S. economy, particularly in light of the fact that the recent era of money printing has done little to boost GDP. The question that looms large is what this decline in the money supply means for the future. Historically, a shrinking money supply has been a harbinger of deflationary pressures, which can lead to economic stagnation or depression. In the 1930s, the collapse of the money supply was one of the key factors that contributed to the Great Depression. Today, the rapid contraction of the money supply suggests that we may be heading toward a similar scenario, where deflationary pressures lead to economic instability and a potential depression. Despite the vast amounts of money that have been printed in recent years, particularly in response to the 2008 financial crisis and the COVID-19 pandemic, the impact on GDP has been minimal. This raises serious questions about the effectiveness of monetary policy in driving economic growth. If money printing is no longer a reliable tool for stimulating the economy, then what options are left? Zang argues that the traditional relationship between money supply growth and economic growth has broken down. The money that has been injected into the system has largely ended up inflating asset bubbles rather than driving productive investment. This has led to a situation where the stock market and real estate prices are at record highs while the underlying economy remains weak. In this environment, gold becomes increasingly important as a store of value. As fiat currencies lose their purchasing power, gold offers a reliable hedge against inflation and economic instability. Zang highlights the historical role of gold in stabilizing economies during times of crisis, pointing out that it has often been revalued against fiat currencies to restore confidence in the financial system. The current environment suggests that we may be on the cusp of another such revaluation. The official U.S. price of gold remains artificially low, while the market price has surged above $2,000 per ounce. This discrepancy indicates that the market is beginning to recognize the true value of gold, and that a major revaluation may be on the horizon. Zang also touches on the psychological impact of gold pricing. The fact that gold coins like the American Eagle have a face value far below their market value is part of a broader strategy to downplay the importance of gold as a monetary asset. However, as the public becomes more aware of the true value of gold, this psychological barrier is likely to break down, leading to increased demand for physical gold. The formation of a wedge pattern in the gold market is another key indicator that gold is poised for a breakout. If gold breaks above the upper limit of this wedge, it could signal the beginning of a major upward trend, driven by increasing demand for gold as a safe haven asset in times of economic uncertainty. Another critical point Zang raises is the breakdown of the consumer-driven economy. The U.S. economy has long been supported by consumer spending, but this model is increasingly unsustainable as wealth inequality widens and purchasing power erodes. The breakdown of the consumer economy is likely to exacerbate the already fragile state of the U.S. economy, leading to further instability. The erosion of purchasing power is a particularly concerning trend. As inflation continues to rise, the real value of wages is falling, making it harder for consumers to maintain their standard of living. This creates a vicious cycle where declining consumer spending leads to weaker economic growth, which in turn exacerbates the very problems that caused the decline in the first place. Zang argues that the current economic system, built on fiat currencies and excessive debt, is unsustainable, and that a shift to a new system is inevitable. This new system will likely involve a return to tangible assets like gold, which have a proven track record of maintaining value over time. The transition to this new system will not be easy, but it is necessary to restore stability to the global economy. Investors who recognize these trends and prepare accordingly by diversifying their portfolios with physical gold and silver will be better positioned to navigate the coming economic turmoil. Gold and silver offer a reliable hedge against the devaluation of fiat currencies and provide a store of value that can be passed down to future generations. In conclusion, the current decline in the U.S. money supply, coupled with the minimal impact of recent money printing on GDP, suggests that we are on the brink of a major economic shift. Gold, as a historically reliable store of value, is poised to play a central role in this transition. For investors, understanding these dynamics is crucial for making informed decisions about wealth preservation and growth. As we move into an era where fiat currencies are increasingly vulnerable to inflation and economic instability, gold and silver provide a reliable foundation for preserving wealth. By staying informed and taking proactive steps to diversify their portfolios, investors can protect their financial futures and position themselves for success in the emerging global economy. For American and allied citizens, recognizing the strategic importance of gold and silver in preserving national economic security is crucial. As global economic dynamics shift and fiat currencies face increasing pressure, these precious metals provide a reliable foundation for wealth preservation. By investing in gold and silver, you not only protect your financial future, but also contribute to the broader goal of economic stability and resilience. Stay informed, take proactive steps, and ensure that your investment strategy includes these timeless assets. In a world of uncertainty, gold and silver offer a beacon of stability and security.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.